try to remember but it's gone. Then you're trying to scream but it only comes out as a yawn when you're trying to see the one beyond your front door.
That's right. Pinch me. Pinch me when this is all over, because this has been an insane couple of days and something that we haven't seen. Actually, if you look at the stock market, look at all the numbers since like 1987. So hold on, we're going to talk about it. We're going to try to talk about what's going on in the refinance world, what's going on with mortgage rates, what's going on with just the flat out market itself, what we need to be doing as loan officers to be ready and vigilant, and how to kind of navigate through these and talk to our customers responsibly and correctly. Okay, so first thing that we're going to see here is on the MBS highway. So it doesn't even matter. As of about 5 minutes ago, that they did suspend pricing. So that's we can't lock a loan right now, and the reason is because the volatility in the market, it's literally just up and down, up and down. And by volatility, I mean I started recording this video and had to change because this morning we were up about 39 basis points, and at the time of recording we were down 42 basis points on the MBS, and now we're back up to 28. Right now it's very uncertain times with pricing, with the stock market. Yesterday was one of the biggest days of losses, and actually the Fed dumped in 1.5 trillion in liquidity into the market to kind of help stabilize the stock market. Didn't really take too much effect to it. So we like seeing these bonds up now, a little 28 basis points, because we want to see some of those gains. So let's talk about this real quick. The graph here. So remember, it's kind of hard to remember because when we see up, we think good. It is good for the MBS to be up. But when it goes to mortgage rates, we're thinking like, all right, we see up, mortgage rates are going to go up. No, it's the opposite, right? So when we see this number here go up, that's usually when mortgage rates go down. So let's take a look at the graph. This is just since December 23rd, okay? And you'll see this is kind of when we started making all those calls for refinances. When I've been talking through here about refinances, because we've seen rates kind of up. And then this is those days of gains that we saw. The massive gains where we started doing those call nights, where the one day we went up so much that we actually had, sorry, I got a phone call coming in. We went up so much that we were seeing unable to price because the investors kept changing prices, and because they kept getting better and better. And this is when we were talking to customers. This is when they saw on the news all-time highs or all-time lows for mortgage rates. And now we see these massive red candlesticks, which you never want to see these, but these massive drops in the pricing, which affects the rates, which is when we were seeing on Monday. Ryan sent out the alert to lock. We sent one out Tuesday. We sent one out yesterday. That's when we saw the drop in the market. Now, what's this mean? Well, where we currently sit, 100.55, so let's find it. 100.55 is where we're at right now. Okay, and you'll see if we go across the way here, about the same pricing as you'll just follow across the across the screen here. We're about the same pricing where we were middle of February. So are people still able to refinance? Absolutely. Because if I extend this out, actually let's go to 2 year. We'll look at the 2 year. Give it a second here. All right, November of 2018, where a lot of these customers were calling. Look at these bond prices, right? 90s, in the 90s, okay? And what that means is when this bond price is down, okay, when the bond price is down, mortgage rates are up. Just remember that, because when the bond prices are down, that's a sign of a great economy, that we're putting money into riskier things that get a better return, all right? Because we're in such a great market. And we have been in the past couple months. Then people started realizing of the inevitable recession that you've heard me talk about, and bond prices started to trickle up. Okay, here we go. And to where we are, where we were a couple days ago. Now, here's the one thing that we've been hearing from a lot of experts in the industry, that do not worry about this massive decline. Okay, we've been worrying about it the past couple days. This is what's called a blip. And it's very common when you see crisis like, I mean, the past couple of days that we've had in the market, because they're trying to rebound, right? And you're hearing the president talk, trying to rebound the market. You see them release 1.5 trillion into liquidity to help rebound the market, and eventually it'll gradually go up. Now, what we're seeing and what we saw from pricing from our investors, and what we saw from Wells Fargo, what we saw from Chase, what we saw from Quicken, is that I saw a number, I don't know if I believe it, but it was $11 trillion in mortgage applications came in like a 7-day stretch, right, during that refinance boom when we were all making all those calls and doing our own loan applications. So during that 7-day stretch, 11 trillion came in, and you're not going to believe this, but those investors don't have that much money, right? We don't have that much money to pay to fund all these loans. So what started happening, you started seeing Quicken and Wells Fargo, all these big mortgage companies, you started seeing them not offer. They were offering 4.125%, while we were offering our customers 3.25%. All right, so they were offering customers ridiculously high interest rates because they were trying to. All right, well, we can't. Number one, we can't hold up with all the traffic we have coming in. Number two, they started realizing, well, they don't have the money. There's no money out there to get all these people this money. So the investors started pricing everybody out, and immediately what we saw with the bonds, I mean, we were seeing record lows on the stock market, which should always equate to bonds being higher. But what we started seeing is that wasn't the case. And the reason it wasn't the case is they're trying to keep interest rates a little higher so we can gradually drop them down and finance some of they eliminated about 70% of the applications when they did that. So imagine having 11 trillion in applications. We have no way to fund those. Here's a way to eliminate 70% of that, and then they accommodated that because a lot of people didn't have those locked in. So that's kind of what was going on the investor side. Let's take a look at the actual market. All right. Give it a second here. All right, so Dow Jones up on the day just a little bit, but what happened is we are now in what we call the bear market. So so you have a bull market, a bullish market where investing is great and the market's doing great, where we see gains. And then the bear market is at any point from when you take the top of where the Dow Jones was at a certain point, and then if you lose 20% or more over that stretch, then you turn into what's called a bear market. Bear market is always a sign of maybe a recession, consumer confidence going down, manufacturing reports going down, jobless claims go up, anything like that. Well, so what we've seen is due to the coronavirus, and then also the oil war between Russia and Saudi Arabia. So that's why oil prices have dropped. It's kind of a little bit of a perfect storm. Right now we're at 21,693, which is actually what I've been reading is pretty inflated. That we're going to end up seeing most likely a Dow Jones in the 15,000 range in the next couple of weeks. So that's one thing that we need to be cognizant of and keep watching, because that's always a sign that, we should have a little bit better rates. But another thing too is we're going to have consumer confidence go down and people maybe not looking to purchase homes. And the one thing as a loan officer that we need to educate our borrowers is during these bear markets, it never fails. Every time during a bull market, people are taking on riskier investments. They're also taking on more debt because they want to, they're making more money. So we have incomes at all-time highs. We have lending that has been not as restrictive as it was during the bear market. And we have more people probably with consumer debt right now, whether it's auto loans, whether it's student loan debt, obviously, whether it's credit cards. Usually credit cards is one thing that goes up during a bull market. So right now, all-time high for property values. We also have still pretty considerably low interest rates. This is a great time to start talking to people about cash out refinances, right? Let's consolidate debt. Let's take all that under one umbrella. That way you're not paying on these credit cards, or you're not maybe paying high interest on car loans or student loans or whatever. Consolidate it into one. and make it a better situation for you during this turbulent times, right? As we move into more non-risky investments. That's a great investment to make in yourself to consolidate debt and open up some monthly payments. So that's one thing to keep an eye on. What I am doing, I think what we're doing, so we have canceled the office meeting for Tuesday, and we are going to look at not holding meetings for like our customers. I'm trying to not have come into the office, do a lot of virtual meetings, take advantage of our technology. All of you have laptops or desktops. Phone calls are big, all that good stuff. So any questions, please let me know. Stay safe, wash your hands, use your elbows, all that good stuff, and we'll talk to you guys later.